Welcome to our Q2 2026 market review. This quarter delivered exceptional returns across nearly every asset class, and we're going to break down exactly how your investments performed and what the long-term data tells us about staying disciplined. We'll also dig into the biggest story of the quarter, the historic SpaceX IPO, and what it teaches us about separating exciting headlines from smart, long-term investing decisions. Let's get into it.
Let's look at what happened in the second quarter of 2026. And this was a quarter that rewarded investors across the board. US stocks surged 15.44%. International developed gained 10.22%. Emerging markets led the way with an impressive 24.05% return. And global real estate delivered a strong 10.76%. Bonds contributed too, with US bonds up 0.67% and global bonds gaining 1.77%. To put this in perspective, look at the historical averages since January 2000. US stocks typically return 2.4% per quarter. This quarter's 15.44 is more than 6 times that average, a genuinely exceptional 3 months for equity investors. But here's what I want you to remember as we go through today's video. Quarters like this one are exciting, but they're also exactly the kind of environment where investors get tempted to chase performance, jump into hot trends, or assume the good times will continue in a straight line. Strong returns feel great, but they also require discipline, which is exactly what we'll talk about next. This slide shows why context matters so much. Look at these trailing one-year numbers. US stocks up 22.8%, international developed markets up just under 21%, and emerging markets an extraordinary 43.5%. These are the kinds of returns that remind us why we stay invested and stay diversified. But look further down the page. 5 years, 10 years, 15 years, 20 years. Every single asset class shows solidly positive returns across every time frame. US stocks have compounded at 15.06% annually over the past decade and 11.16% over 20 years. That 20-year number includes the 2008 financial crisis, the 2020 pandemic, and every market scare in between. This is the payoff for patience and discipline. Investors who stayed the course, who didn't get shaken out during the scary quarters or seduced into abandoning their strategy during the euphoric ones, are the ones capturing these numbers today. And that brings us to something incredibly relevant this quarter. How do we think about hype versus long-term discipline when something big grabs the headlines? I've adapted this from our written commentary. Go check it out if you want the full scoop. This quarter, one story dominated client conversations more than any other: the SpaceX IPO. It was the largest IPO in history. Shares surged from $135 to over $200 in early trading, and it briefly pushed SpaceX's valuation above $2.6 trillion, making Elon Musk a trillionaire in the process. It was, without question, the kind of debut that gets everyone talking. So what should investors make of it? Here's the honest answer. No one knows yet whether this is the entry point into one of history's great companies or an overhyped mania. What we do know is that on current earnings, SpaceX looks expensive. With about $19 billion in sales, trading at a value similar to Amazon or Microsoft, companies with far larger revenues, the stock is priced more like an established giant than a company its size would typically warrant. History offers a caution here too. Looking at the 15 largest US IPOs since 2006, the average stock fell 50% at some point in its first year and finished that first year down 33% from its IPO price on average. The lesson: the most exciting story rarely produces the best returns. That's why we build portfolios around discipline and diversification rather than chasing whatever's dominating the headlines.
So here's the takeaway. Q2 was a standout quarter. Long-term returns remained strong across every asset class, and even amid an exciting story like the SpaceX IPO, the fundamentals of disciplined, diversified investing haven't changed. The most exciting story in the market rarely makes the best investment. patience and diversification consistently win over time. Thank you for your continued trust. If you have questions about your portfolio or how these trends apply to your plan, we're always here to help.